and this podcast is for informational and educational purposes only and does not constitute financial advice. Please consult with a qualified financial professional for advice specific to your situation. The views and opinions expressed are those of the hosts and guests and do not necessarily reflect those of the podcast producers or sponsors. We make no representations or warranties regarding the accuracy or completeness of the content. Today, we are talking with Mike England, who focuses on short-term macroeconomic forecasting and calculating quarterly GDP figures for the U.S. And I wanted to have a discussion because many people place emphasis on where we are in the cycle when they're investing. So, Mike, thank you again for coming on. Can we just start with what is an economist and how do companies utilize them?
Yeah. So first off, thanks for having me on. Yeah, economists in the 60s and 70s were often hired by companies that the notion that they had the genius economist and they put together some sort of macro outlook and they'd link their company's performance to that outlook, assuming they had sort of an inside scoop. And financial markets did the same thing. There were sort of these sort of guru economists on trading floors, and everyone thought they had the best angle. And through the 80s and 90s, as the information industry advanced, it became pretty clear that forecasts are a dime a dozen. Essentially, go to Bloomberg or Reuters and see tables of everyone's forecasts. Research shows that consensus forecasts are probably the best indicator of what's happening in the economy. So if that's what you're using an economist for, you probably don't need one. Essentially, corporate economists and trading floor economists really do two things. One is they help you understand what upside and downside risks exist for the economy and put it in some sort of framework. And economists spend a lot of time understanding the size of different industries, the mix of industries in different countries. So if something happens like a strike or a hurricane, economists are there to sort of explain what the likely impact is on other data that might affect the company. So if it's a corporate economist, it'd be the sales of the company. If you're on a trading floor, of course, it's going to be bond prices and stock prices. So economists are there to sort of put some sort of a fabric around events that are happening and what it means for the overall outlook. And then the other is to do scenario analysis to basically explain if we were to underperform over the next 2 to 3 years, what would that look like? A lot of people like to take downside risk and upside risk and put it into more human form. What does it look like if interest rates are going to fall over the next couple of years? And you can go through a scenario where the economy weakens sharply, maybe the war in the Middle East escalates, and they kind of get their mind around, oh yeah, I guess if the world unfolded that way, interest rates would fall. And you can tell these same sort of stories to the upside and explain why interest rates might go up. So economists are sort of there to help other people manage risks is what it really boils down to, and to figure out how to manage those risks with respect to economic data that gets reported.
Sure, that's extremely helpful. No pressure, right?
That's right. Well, since economists are seldom right, there isn't really a lot of pressure.
Yeah. It's kind of like, kind of like the weatherman, right?
Yeah.
And you started off by saying these were really brought in the 1960s. So over just starting from 1960s to now, has their role changed at all, or has it really remained pretty much the same?
In the 60s and 70s, that was essentially the time the federal government started playing with Keynesian economic policy. And Kennedy in the early 60s engaged in tax cuts, which were viewed as highly successful. And various macro models were built after that. Klein famously built the Wharton model. The DRI model was built later. And there was sort of a sense in the 60s and 70s that economists were going to figure the whole thing out. And we'd know exactly what the economy was going to do. And then we'd tell policymakers exactly what the stimulus package should look like. And we'd never have a business cycle again. And as that progressed into the 70s, obviously that optimism wasn't warranted. Many attempts were made at policy. And it turns out the world's more complex. And in the 80s and 90s, people started to move more toward a rational expectations view of how markets work, how the economy works. People are forward-looking, expectations are important. And the model started to get very abstract, very mathematical, and very hard to find how a policy action could actually have some sort of desirable effect. So this whole sort of experiment of the 60s and 70s of the genius economist or the guru economist really has converted more into the work of a statistician and someone who's doing risk management. So it's a very different focus for the individual.
Right. And I know we get a lot of questions about policy and how that will impact our investments, but it's always hard to say because the policy could disintegrate the next day, right? So it's really hard to say what will actually stick. And it's almost as if you just have to wait to see what's enacted. Of course, being a little bit proactive, but it almost feels like you can't really do anything until a certain policy is actually pushed through.
That's right. And if you're looking in the corporate sector, essentially, it's a lot easier to figure out policy impacts that are direct, tax law
Mm,
changes that may affect a particular company, or laws that would change sales tax rates on particular products. But when it comes to the macroeconomy, the idea that investors should be bracing themselves for a particular scenario to unfold because they think they've forecasted the economy is a little crazy. In fact, there's one investor, Peter
mm,
Lynch, who's kind of famous for Fidelity Magellan Fund. He's the one guy who statistically seems to have consistently beat the market. And that fund grew to be
mm.
an enormous fund because everyone wanted to sort of ride with him. And I think
Right.
as it got bigger, it became harder to manage. But he was once asked if you spent, do you incorporate the macro outlook into your overall view? And he said, if you spend an hour each year thinking about the macroeconomy, you probably wasted 50 minutes. So
Wow.
he does think about it, but for him, it's really selection, stock selection, industry selection, and the idea that should take a bet on the over under on the economy when you've got armies of people out there trying to estimate what growth will be, and you think you have the better idea of whether it's going to outperform or underperform. It's sort of a fool's game.
Yeah, so this brings up two questions immediately for me. So first, you said that he then started growing in AUM. So did his performance weaken after that? He just kind of was maybe spread too thin?
Yeah, I'm not an expert on him, but I think the study showed that as the fund got bigger, he obviously had to find more companies, and so he had to hire
Sure.
people, and wasn't even involved personally with the stock selection as the fund
Yep.
grew. And I think his performance converged, but I think he retired essentially as a champ. I think he did beat the market
Okay.
pretty consistently. He quit managing funds.
There you go. Yes, it's always so interesting. You have two camps, right? You have the more boutique investment firms, and then you have the big investment firms. And I'm in real estate, so I equate that to maybe like a Blackstone. And you always wonder if these big kahunas like Blackstone have such a big need to get their AUM out the door because they're having so much inflow that if that really does allow them to still be good stewards of wealth if their main goal is to just keep getting that capital deployed.
Mm-hmm. Yeah,
And then you
companies
were
do have to know their
also, oh,
comparative
sorry, go
advantage.
ahead.
I was going to say companies do have to know their comparative advantage, and if they find that they're investing in a way that doesn't reflect their own input, it obviously makes it hard to maintain your performance.
Right, absolutely. And then you were talking about if you're focusing on the macroeconomy for 60 minutes, 50 minutes of that is wasted. So is that why you stay away from macroeconomics with your own investment portfolio? I know we were chatting about that earlier.
Yeah, it's interesting. And the work that I've done, I've been a market economist since 1982, and I've essentially had jobs where I write commentary on the formation of market expectations. So I've been kind of a financial market reporter, calling economists on different trading floors, and been doing that now for 42 years. And so you get this sort of feel of how economists think about things, and it's interesting. I saw some of that transition in the early 80s when I talked to people. They wouldn't want to give you the real view they had in the economy because if they told you, they'd have to kill you. It was like
Mm.
deep, dark secrets that they let you in on. And by the 90s, that obviously had already transitioned. And we talked more about portfolio risks and so forth when I was on phone calls with people. And it's pretty clear that if you're a market player, you can't trade during the day because you're on a trading floor. So
Hmm.
obviously, you only trade on your financial institutions' accounts. They all basically have buy and hold strategies. And the reason they do is because they can see the information that traders have on trading floors that they're incorporating into market prices. And if you're sitting in your cubicle as an engineer in New Jersey, the idea you're going to beat Goldman Sachs, you're going to beat Morgan Stanley is really kind of silly. And when the
Right.
risks come, they come out of the blue. You're in the trading floor watching news flow. You think you've got a great position, and all of a sudden a news headline pops up, and you think, uh-oh, and you realize you're on the wrong side of the trade. Markets don't wait. So by the
Yeah.
time you've seen the news story, it's over. You get this sort of sense that it's kind of futile for an individual to try to gamble around the outlook. The real idea you should have is, what are your personal liabilities, assets? You're going to have cash needs, a kid going to college, and to really plan your portfolio so you can minimize the risk when you're going into and out of the market. And it's interesting when you have a job like mine because when you meet people that aren't in the financial market, often the way they
Hmm.
think about investing is, give me a hot tip. What should
Yeah.
I buy? It's kind of funny. Anytime someone asks you what should I buy, you know that they really don't know much about the financial market because
Right.
it's not really a question of picking either timing issues or picking individual stocks. If you're not a player in the market, you want to have a diversified portfolio and you want to have a buy and hold strategy.
Yeah, and in that vein, do you have experience with people who have tried timing the market?
Our clients all time the market. So it's their
Mm,
full-time job. And, like I say, if you're on a trading floor, you have that advantage. And the main way that markets on the sell side time the market, individual traders have a sense that prices aren't moving enough off of retail sales number or are moving too far. So when they're buying and selling, they're offering quotes on both the bid and the ask, and they can give aggressive bids or unaggressive bids based on whether they want to be buying or not buying. And so they'll essentially resist a movement in a price if they think it's going the wrong way. They'll be quick to sell and slow to buy. When they think it's gone too far, they switch over to where they're quick to buy and slow to sell. And so essentially they're through the day making marginal bets, and it works for them. Essentially,
hmm
people from trading floors will say the performance of a trader is pretty substantial. If they don't make performance, they're fired quickly and replaced with
Yeah,
someone that has that ability to do that. So I see people trade the market and I see them trade it successfully. But I think if you're not on a trading floor, the idea you're going to do it as a side job while you're doing your day job somewhere else, I think is probably a poor strategy.
I agree with you. And going back to what you were saying a little bit ago, the individual investor, if they're reading something in the headlines, I think it's probably already too late.
Absolutely. And there's low latency trading now. There's so much quant trading going on. There's actually companies that have located their physical servers closer to the government. So when data comes out, the line is shorter. So at the speed of light, they can get their trade in before other companies. So the way
Hmm.
trading is done nowadays, if you're actually reading an article, the timing is now based in milliseconds, not seconds. And so
Yeah,
you're not even in it.
right. Right. Yeah, we're moving a lot faster these days.
Yes.
What is the typical behavior and effects when there's maybe fear of a recession?
Essentially, when there's a fear of recession, that to a large degree is what some economists think caused recession. Essentially,
Mm,
there's different ways of thinking about the business cycle, but I think a rational expectations approach is probably the most warranted. When we've had cases of policy actions that unfold over time and everyone thinks it's obvious the economy is going to grow faster, it's obvious the economy is going to go into slowdown, people adjust slowly and accordingly, and there's no cycle. But when something happens, it suddenly happens and catches everyone off guard at the same time, people tend to change their behavior at the same time, and that arguably is what causes downturns. In the 2008
hmm,
Great Recession, for instance, we had some collapses in the high yield markets in debt, some concern about first Bear Stearns, then Lehman Brothers and other financial firms. And everyone saw this news at the same time, and everyone became cautious at the same time, and we've been into a pretty deep recession. Interestingly, there have been other times where economists all thought we were going to go into a downturn and didn't. For instance, through this last Fed tightening cycle, the Fed tightened pretty aggressively. If you look at a 100-year graph of interest rates, the Fed was pretty aggressive in trying to address inflation. And everyone's, obviously the economy is going into recession. And it was interesting talking to economists who every quarter had the recession starting next quarter, but recession never came. And the reason is because we slowly came to a realization. People
hmm.
didn't have that sudden exogenous hit that caused them all to change their behavior at once. So we changed our behavior slowly. The savings rate trended down as we spent all our stimulus money, which we had plenty of. And we slowly ran out of stimulus and we slowly raised our savings rate. Normally, a jump in the savings rate throws us into recession because that's what happens when people get cautious. They quit spending. But then if firms
Yep.
can't sell, they lay people off and then people get more cautious. We didn't all stop spending at the same time. And so we actually went through a transition where the economy, if you're looking at GDP, it's actually accelerated the last 3 years through this time when it was
Hmm.
obvious that we were going into a downturn. So you can kind of see both extremes of the last two cycles. One where everyone panicked at once, and the other when everyone panicked at a different time and essentially got
Huh.
lost in the noise.
That's so interesting. And in this macro view of just being a long term holder, if we were all in an ideal world, would we all be long term holders?
You
And
know,
how would that look?
Yeah, I think each individual investor should look at their life cycle, and the investment should make sense for their life cycle. So when you're young, obviously spending as little as possible and starting a portfolio makes sense because earnings are exponential. And so
Hmm.
the earlier you start saving, the better. And obviously you want to be investing in risky investments and high growth stocks because that's where you're going to get the highest yield. And you've got 60, 70 years to hold that position. So, and obviously diversifying. You don't put it all in one risky bet, but you put it in funds that, for instance, make risky bets in mass. And as you get older, people say you move to bonds. And it's interesting. I've read some
Mhm.
retail research that suggests the return to equities is so much higher than the return to bonds and real estate
Hmm.
and short-term money that actually the whole notion that as you get older, you should hold more bonds may not be true. It may be the case that equities are so much better of an investment than all the other markets that you should just stay in equities the whole time. I don't know if that's true because I don't do individual investment advice and I haven't delved into that far, but I know that there have been quite a few articles that have really focused on that now. So obviously, as you get older, moving toward bonds to stabilize your return might make some sense, but stocks are such high performers, you've got to be very cautious at getting away from stocks.
Yeah, personally, if I'm reaching retirement and the rhetoric says to stay in equities, that would give me a little bit of heartburn because if next year my stock portfolio goes down, I'm out of luck and I can't retire. So it just seems like bonds would be a safer play there.
Yeah, moving to bonds. I've heard quite a few investors use the expression you want to have a portfolio mix that allow you to sleep at night. So
There
the
you
real
go.
question is, do you really feel protected? And one strategy, if
Right.
you are highly successful financially and you've got a nice retirement nest egg, is to have a bond portfolio that will finance your life. So
Yep.
essentially, even if the stocks all go to zero, you still have a fixed income. You
Right.
know, that you can hold them to maturity. You're not going to take the principal hit. And if you have that luxury, most people don't. I think the average person retires with $200,000, 300,000, which means they've got to play it
Wow.
just right because it's not a lot of money
Yeah.
to retire on.
No, no, definitely not. And I know as an individual investor, we're not on the trading floor. We can't make these strategic moves as intelligently and eloquently as someone whose full time job it is to make those decisions. But if we focus on monetary policy, maybe even taking a step back and asking you to explain how does monetary policy work, and what channels can we all get more educated on this?
Yeah, so it's kind of since the great financial crisis in 2008, there's really been two channels, and I would argue it's my own opinion that there's really only just the original one. The standard channel has been reserve management and sort of Milton Friedman's
Mm,
monetary theories of the 70s and 80s from most people who had taken macro, you know, courses in college. That's kind of a framework for thinking about monetary policy. And essentially, managing the reserve path manages the supply of money, a complexity since the Monetary Control Act back in 1980 and the slow evolution since then is all financial assets are to some degree money now, and there's this continuum. So we don't really know what money is. So reserve management transitioned to interest rate management, which you can show in theory kind of it's the same thing, but essentially since the 90s, the Federal Reserve is focused on an interest rate target rather than a reserve target because it's kind of hard to
mm,
know what reserve should be. And so that's been its primary avenue. When the financial crisis hit in 2008, they invented quantitative easing, the idea that they're just going to go into the market and buy up tons of securities so that there's this underlying demand for securities. And I would argue that during periods of illiquidity, this matters. When we had the later COVID crisis, the Fed Reserve stepped in again. By buying huge volumes of securities, you essentially tame the market. People who are on the sell side are willing to take long and short positions because they know they've got a customer. Essentially,
mm,
the Fed will be there to buy as buyer of last resort. So it does
yeah.
stabilize markets. Over time, someone would say, well, why wouldn't that inflate the economy and so forth? What people don't see is there's two sides to every transaction. If I give you something, you give me something in return. And when the Federal Reserve buys all of the Treasury issuance for a 2 or 3 month period, they replace it with reserve credit. Well, reserve credit is just like a Treasury bond. So all they're really doing is switching what is a
Mm,
perpetuity, a reserve overnight reserve asset in a liquid market, for a Treasury bond, which might be a 10-year, which may not be a perpetuity, but it's essentially a near equivalent instrument. To a bank, they look like the same instrument. So in the short run, you've got activity in the market, so banks know they can buy and sell. But over time, that probably isn't a factor. So a lot of people that write kind of hysterical articles about, well, the Federal Reserve is going to blow up our currency, blah, blah, blah. Look at the portfolio. Yeah, the portfolio has expanded rapidly, both with the financial crisis and then later with COVID. They have an enormous portfolio now, but they've essentially swapped it all out with reserves. We would have been holding Treasury securities. Now we're holding reserves. I think that's probably not as important. And the Fed has been slow to unwind it. I think it's probably as irrelevant on the downside as the upside. They probably could start dumping a lot of those treasuries and it probably wouldn't have much of an economic effect. So ultimately, when the Fed wants to slow things down, it raises interest rates. And when the
mm,
Fed wants to
mhm.
boost the economy a little, it lowers them. And I think interest rates are really the primary channel they have. And short-term interest rates, they can't control long-term rates, but short-term rates are really their one vehicle for controlling growth.
And it's interesting because right now in the election, we have two candidates, and neither one really have even discussed the federal deficit. But what are the potential risks of a debt crisis, and how can investors prepare?
Yeah, it is kind of sad as an economist to see that the country really has lost interest in controlling the budget. Looking at our country through about the early 2000s, we had a natural austerity. The Germans are the extreme. They have extreme austerity sort of hardwired into them. But the Americans had an austerity too, and we really did a good job of controlling our budget deficits, even though we talked about it a lot. Each time the deficit got wider, we'd address it. Bill Clinton actually pushed it all the way to surplus to fix the deficit that came out of the 1980s. So we used to be a pretty conservative country in the sense of really wanting to manage our country's finances. That's no longer politically popular. The good news is that we actually bought ourselves a lot of slack. Since we've kind of become a crazy country only for 10 or 15 years or so, we've got a long ways to go before we'd actually face a debt crisis. But what we are going to find as we look more and more like Italy and less like Germany is the interest rates our government's going to have to pay are going to get higher and higher. We're the reserve currency, so our treasury yields are remarkably low. So we can borrow pretty cheaply, but that's going to be less and less the case going forward because we have this massive deficits. I think it's going to be a long time before we actually have a currency crisis or have some sort of collapse like you saw with Greece for a period and the troubles that we saw in the EU, just because we've been so cautious up until recent times. But obviously, we should be addressing these deficit problems, even if they're not an immediate threat.
And what are the pros and cons of being more like an Italy and less like a Germany?
You can countries tend to get into this situation when there's different factions that form that want financing for a cause that's their cause, and they're not really that concerned about what broad costs might be imposed on everyone else. So you end up with a lot of different factions fighting for a lot of different spending strategies. And so Southern European countries have generally ran deficits and generally had a currency that would depreciate relative to the Northern European countries. The Northern European countries tended to be focused more on a balanced budget. Germany had its hyperinflation problem in the 1920s and never really reversed its attitudes about inflation since then. That destroyed their economy and actually literally killed people. People were living at a subsistence level. So they very much fear inflation. When we in Europe moved to a common currency, the basic problem is the adjustment before was simply that Southern European currencies just slowly depreciated, which is like a little escape valve so that they could exist next to each other. But now what happens is, since they're all sharing the same currency, there's no escape valve. So in Italy, they have constant budget problems and they have constant restraint, which is politically unpopular. So it tends to make the region politically unstable. In the Northern European countries, they don't get the full benefit of their austerity. So they're frustrated and tend to try to take action through the collective EU. And so essentially, there's just two different policy paths and they're tied together, creating a sort of tension. So there's a real question whether the different European countries really should be in the same fiscal union. They're in a monetary union and they're trying to move toward having more similar fiscal policies, but perhaps that will never happen.
Okay. And what are the levers that the government uses, or what are the main aspects that move the economy when they're trying to balance all this?
We talked about monetary policy, fiscal policy. Essentially, a lot of economists really soured on the idea of Keynesian policy coming out of the 60s and 70s, both because we found out the models didn't work as simplistically as we thought, with the complexity of how people think and expectations. It's kind of hard to second guess people and trick them into spending more or less when you incorporate into your model that they're expecting what you're going to do. But you also have the added problem that you have to pass any policy idea through the political process. And especially in the US, it's both a feature and a bug. We've designed a system that would keep the federal government as limited as possible. Our US Constitution split up and pitted the three branches of government against each other. In Europe, they have parliamentary systems. So they're sort of like short-term dictatorships with the periodic elections where they replace the dictator with a new dictator. The US, basically, we have factions. So we have a House, we have a Senate, we have judiciary branch, we have the presidency, and they all have different ideas. And so they lock horns. And it's sort of a natural way to make sure that policy only happens if a supermajority of people agree. Things that are 60, 70% supported tend to go through. Anything short of that just gets all tied up and clogged and people throw mud at each other. So when you're trying to put together a smart stimulus package, it's kind of hard to do that and play the political game at the same time. The one thing that we've done that has worked, and we've done it a few times now, are the idea of stimulus checks when there's a severe exogenous crisis. And so twice or a few times we've done this. With the great financial crisis, we put together a package, and when we distributed stimulus checks, people pretty predictably spend them. You can do
Yeah,
consumption forecasts, and you pretty much can calculate by looking at how the savings rates change with past stimulus checks, how much extra they're going to spend. And it's sort of what Keynes used to call a pump priming. It sort of causes this sudden surge in demand, which maybe if producers produce more on that surge, you might save the economy a little bit. We did it twice with COVID. The initial CARES
right.
package, arguably most people in the world thought we were the world leader. We did come out with a huge package. And actually, I think with hindsight, probably exactly the right size. The CARES package was quite large, had stimulus checks and had checks through PPP loans to businesses. And it pretty much completely reversed the hit from the pandemic. Most people at the time didn't think so. They laughed at people that said that. We actually passed another stimulus package after the election in 2020 because I think all the politicians wanted to claim credit for saving the economy. So they did their stimulus package. And then Biden came in and he wanted to claim credit. So he passed another stimulus package, which we passed in February of 2021. And that was a massive overshoot. And this sort of, in my mind, comes into the sort of muck that happens when politics get involved. The initial CARES package was well thought out. I think most politicians were overwhelmed with the COVID crisis. And, people, I think, all went to college and they know what policies will work. And they slapped the CARES package together and it worked. But after that, they went back to games and we spent a lot of extra money. And it's controversial, but I think basically that second and third stimulus packages are why the price level ratcheted up because we were already at capacity. People were
Right.
describing the economy as under capacity. And if you went to Broadway in New York, it looked like we were under capacity and nothing was open. But if you
Yeah.
went anywhere else in the country, everything was bursting at the seams. It was hard to eat at a restaurant in most of the country because there weren't enough waitresses or waiters.
Yeah.
You'd be in and the parking lot was filled with tables because they could be both inside and outside. So the country was kind of bursting at the seams. And then we threw all the money on top. And of course, we ratcheted up the price level. And now here we are. We have gotten the inflation rate down. But that whole collection of policy mixes were probably a wash. One great bill followed by kind of a couple crazy ones.
Mm. Yeah, that's exactly what was going to be my question. Do you think the stimulus now has contributed to these high prices now, even in homes, right? Affordability is really hard. But it sounds like you probably agree there.
Yeah, and in monetary, some people like to focus only on monetary policy, and they'll say, well, look at the Fed portfolio. They bought all these securities, and interest rates were practically zero for 2 years. And that, of course, I think was a factor too. But I think that the real awkwardness was, and it's both parties, deciding that we were going to throw more money at an economy that actually didn't need it. But no one wanted to say that out loud because everyone had their own game to play. And so our political system is messy unless we're truly under pressure, which we did react at the beginning of the global financial crisis and in March and April with the CARES Act with COVID. But other than that, we tend to create more of a mixed result as people try to fight back and forth aside from what should actually be done for the economy.
Right. Yeah. It's I'm sure there's a lot of differing opinions and coming together to find the right one is way harder than it seems.
Yeah.
Moving to today, what are current macroeconomic trends you're seeing?
So the inflation rate is coming down. So we are kind of moving more to a stable economy. We've slowly rebuilt retail inventories, and we're still not there. Remarkably, we're 4 years out of COVID, and we still haven't been able to restock the shelves. We had a lot of new rules and regulations with industries like autos, and so autos are much more expensive because now automakers have to make lots of electric cars that no one's buying, and they have to make up their money with a smaller number of internal combustion engine cars, which
Mm.
are way overpriced. So if you go to buy a car, and I had to buy a car because a child had a car accident a while
Oh
back, and
no.
we suddenly got thrown into the new car market. It is remarkable how much cars cost, and you really don't have a choice if you want a new car. And used
Right.
cars have ratcheted up too. There's a thing called the Manheim Used Car Index, and used car prices are still 20, 30, 40% above where they were. So we've got
Wow.
shortages of retail goods, but we're slowly sorting our way through. Factories and wholesalers have largely recovered. We don't have the port problems that we had before. So the slowdown in inflation has been good news. Unfortunately, when you have a big change in the price level, unlike on a blackboard where economists have perfect markets, everyone's wage adjusts by the same amount, everyone's fixed income return changes by the same amount. Reality doesn't work that way. So when you have a big increase in the price level, some people are winners and some are losers. Most people have a job where they have a fixed wage and they can't go in and just say, gas costs more. Could you pay me more? Just no one does
Mm.
that. So if you're stuck with a fixed income portfolio, or if you have a job in a big company where you get a 3% pay rise every year, you couldn't keep up. On the other side of the coin, if you have a large stock portfolio, the biggest beneficiary of these huge packages has been stock prices. So a lot of people made an absolute killing off of the stock market. So we've got a small percentage
Yeah.
of the economy now that has a massive wealth build. And so here we have a stabilization in inflation. We have a stabilization in our economy. We're actually performing pretty well. We're growing, 2.5% or so, and it doesn't look like there's much risk of the economy slowing. So that's probably all good news. But we have shifted essentially purchasing power away from people who didn't benefit from the inflation. So, and that's, I think, how come when you see surveys of the public, we've gone through this sort of period of the strongest demand relative to supply in our lifetime. You're in the real estate market. The same thing's true if you're a home builder. I mean, no matter how many homes you built, you'd sell all of them. Life couldn't be better. But you ask people, and of course, they're all worse off because personally, they can't afford the car they could afford 4 years ago. They can't afford
Yeah.
the family vacation they used to go on. They suddenly can no longer go on a family vacation. So they've got a negative response to what on a blackboard to an economist who's not looking at distributional effects would say, wow, this economy's pretty good. Why aren't people happier?
And I think I read today that car loan debt is up again too, which is another interesting data point. So, what is your short-term forecasting?
Yeah, our assumption is the economy is going to do fairly well for the next 2 to 3 quarters. There's really no sign of a slowdown. My focus is always short term. So I'm
Hmm.
always looking for signs of leading indicators of a downturn, and that's what we usually write about. And we're really not seeing any of that. That we have seen like initial claims have gone up recently. That was in the news the last couple of weeks. We've got these crises that have hit the southeast. We've got 2 hurricanes. We have a Boeing
Hmm.
strike with 30,000 workers. Not clear when that's ever going to resolve itself. So that could escalate. It's 170,000 people work there. So slowly they're going to start laying people off. So that's going to be a mess. But these disruptions tend to be short term. We're assuming they get resolved. And so the economic outlook in general is probably pretty good. How we're going to sort out this big hike we've seen in prices, um, and how the public is going to absorb this, essentially with time, prices should adjust. What economists call relative prices as opposed to the overall price level. But hasn't that's been a slow process, and it may take more than one business cycle to sort that out.
Yeah, we'll see. Time will tell.
Yes.
Is there anything that you wish just individual investors, everyday investors would ask you, or is there anything else that you'd like to cover?
We've talked about a lot of different subjects. I think in general, for individual investors, the idea of having a diversified portfolio and trying to stay away from hot tips is essentially important. One other issue, and you mentioned you're in the real estate market. I think there's a lot of people that get confused about real estate because most individuals buy real estate on margin, uh, but
Mm.
they would never buy stock on margin, or they never buy bonds on margin. You put down 20% and you take out an 80% loan to buy something. It's pretty bold. Um, so a lot of people who go into real estate, they get attracted to it because they know people that made a ton of money in real estate. And they're not really recognizing that they may feel like they made a ton of money in real estate because it's leveraged. And
Hmm.
the return of stocks to other assets is huge. So for a lot of people, I often think, I wonder if they really sorted through a house as an asset. If you have an ETF or a bond fund or a stock fund, you never have to fix the roof on it. You basically put your money in, and that appreciation fully drops to the bottom line, and you don't get taxed on it until you sell. So it's really a tremendously advantaged product. When you own a house, there's a lot of downside. So, but a lot of people really focus in their early years. They want to get a condo, they want to get their first house, then they want to upsize to a bigger house. And during the years that they could have been putting it into a lot of venture capital funds and small company high growth funds and accumulating money. So it's probably the second systematic error people make. One trying to pick stocks and play the market, and the other is essentially
Mm.
having too heavy a skewing toward real estate.
Yeah, it's interesting because I personally don't consider my home an investment. I think that's completely different. I think that when you're maybe putting your money with an operator who lives and breathes real estate, that's different than homes. But I do think that for diversification, real estate can be attractive. And to your point, it's definitely important to pay attention to the leverage because that's where you can get caught and hung to dry. But I do like with what you started with, meaning that your investment portfolio should be diversified and it should have a long-term outlook. So maybe not putting so much heavy weight on these macroeconomic conditions and cycles, because no one really knows what's going to happen. Just because something happened in the past doesn't necessarily mean it's going to be the same way this cycle or for this specific scenario. So just having that more long-term view is something that's super interesting.
Mhm. And another point to add is that with real estate, a lot of people don't think of the hedging strategy that comes with real estate. And that's if you're going to live in a community and you know you're going to be there a while and you can find a house that is adequate for you, buying it is a way to lock yourself into that community. And I lived for 20 years in Silicon Valley and moved to Colorado in 2001. And it's interesting going back because I've had friends that were in Silicon Valley that said, you got to pay to play. Essentially, if you're going to be in that
Mm,
economy, yeah, you're going to have
yep.
spectacularly expensive houses and high prices. You just have to deal with it. And I look back and, I couldn't buy the house I sold when I left. I wouldn't want to move back from Colorado anyway. But, it's one way of thinking about if you can afford a house in the community where you think you're going to work indefinitely, you like where you are. It's a good hedging strategy to stop yourself from getting priced out of your own market.
Yeah. No, another great point. California is also a different beast all on its own.
Yeah.
Very good. Well, let's end with a quick 3-question fire round. The first is, what is a book that you've read recently that you would recommend?
There's this great book called, let me think, it's called The True Believer. It's written by a guy in the 1940s who was, I think, a longshoreman discussing mass movements. And I thought it was quite fascinating because it had a lot of application to the current time. But he wrote it right after World War II, and he was sort of linking different patterns he saw to, what happened in Europe with the Nazis, what happened in Russia with the communist revolution, and what might happen in other countries going forward. So I definitely would
Hmm,
suggest reading The True Believer. It's easy to read too. It's very he's very concise. He doesn't waste a lot of words.
nice. Yeah, yeah. Yeah, sometimes those history books can be a little bit overbearing. But if he's done it in a nice way, then that makes it a little bit more digestible.
Yes.
What is your favorite way to stay up to date on the news?
Twitter. Essentially,
Really?
at first I didn't like watching Twitter when it first came out. I had it up called up while I was working, and I found that Bloomberg and Reuters covers things pretty quickly, and I didn't find an advantage to it. But now, or at least the last, and I don't think it's just recently. I mean, the last 5 years or so, the news appears on Twitter before it appears anywhere else, and I have usually CNBC or Bloomberg TV called up while I'm working because if something happens in the
Yeah.
market, they'll tell you. And it's a pretty good 5 minute delay between when I know something happened on X, and then all of a sudden I see the breaking news, and it's
Wow.
kind of funny. And often you find that when you do see the breaking news, they literally are taking the images off the same tweet you saw. Um,
That's funny.
yeah, so I think the direction of causality initially was from news to Twitter, but now I think it's actually from Twitter to the news.
Wow. What are 2 or 3 people you follow on, or rather, who are 2 or 3 people that you follow on Twitter that you'd recommend?
I like following essentially the different news companies because they post
Okay.
their articles right away, but also people call it financial Twitter. And anytime I see someone post an interesting graph or chart or have an angle on the market, I follow them, and then I see who follows them. And they often repost things. And maybe I didn't like it as much at first, probably because I wasn't following the right people. But now I follow a ton of people. I follow like 1,000 people. So
Wow.
I set quite a feed, and I can just refresh it every now and then if I want to see what's going on. And with all those people in the financial market, somebody sees something at some point, and I'm on the different news wires because if there's an assassination somewhere, usually the
Yep.
local news reports it, and you see it there, and that's our local television stations take a long time to digest, and
Right.
local newspapers take a long time to digest it.
Yep. Like you were saying, it's on Twitter before it's even on the television.
Yes, it's a great way to
La-
watch about 1,000 channels at once.
yeah, exactly. There you go. Last question. If you got $100,000, how would you invest it today?
I'd put it all in equities, essentially.
Okay.
Spread it across those same philosophy we talked about. I mean, I wouldn't put it all into certain sectors. I wouldn't try to guess the sectors of small, medium, and large companies. And lately I've saved through ETFs. So I think
Mm,
that's probably experts seem to think that's the best route. So I don't have a personal reason to think that, but I follow their advice.
Right, like you were saying, it's hard to beat the market.
Yeah, exactly.
Well, Mike, thank you so much. I hope people feel more educated when they're considering the economy and investing. Until next time, adios.
All right. Good talking to you.